Hi, Matt Batty here again, and we've come to another end of year. So first of all, I want to thank all of you, our clients, for another year of support. 2022's been a pretty interesting one, and we'll get into some of the summary of that in a minute. But this time of year is always a good time to reflect on the things we have, and we'd like to say thank you for all of our clients for allowing us to continue to serve you and by extension, look after our own families. So best wishes to everyone over the holiday season. Hopefully we get a bit of summer and a bit of sunshine and warmth, and we'll certainly look forward to catching up with you all again in the new year. So I thought we might start by having a look at what expectations we're setting, what our thoughts were at the same time last year, and sort of seeing how we go. So last year, the major themes we were faced with was we thought economies around the world were starting to learn to live with COVID. COVID as a pandemic was beginning to reduce certainly in terms of a major sort of theme, although infections continued to be at quite high levels. Generally speaking, economies had opened up and people were getting used to living with COVID as a more sort of normal part of life. We had a lot of supply chain issues. There had been a lot of congestion and a lot of disruption to supply chain. And as a result of that, we were seeing some inflation, part of that being sparked by certainly the stimulus that had been undertaken throughout the world during the COVID period, but also just because those supply chains were certainly driving up a lot of constraints in terms of supply, while demand was still very, very strong in most areas. We'd been talking about this theme, the valuation disparity, for a number of years. We were finally starting to see the end of that, and we were expecting markets to be around about an average return. Not a particularly great year, but we certainly weren't expecting any major sort of catastrophes. So how did that play out? Well, I think by and large, economies around the world really have learnt to sort of cope with COVID. The one exception of that being China, still pursuing very much a sort of zero tolerance policy, but even in recent months, we're starting to see a potential sort of relaxation of that. So even China's starting in some respects to open up, but there's still quite a lot of disruption going on in China from a COVID perspective. Supply chains has certainly eased to a large degree, and we've seen that inflation probably peaked in terms of CPI data at least. And in particular, in response to that, we've seen quite a severe rise in interest rates. We talked about that during the year, so I won't revisit that too much in terms of detail. Suffice to say that we're not probably finished yet, with a little bit more rate rises to come early in the new year. We're definitely seeing, though, the valuation disparity turning, and we'll get into some of the data and some examples of that in a moment, but that the worm certainly has begun to turn from a market perspective. So markets, though, however, for the year have been the first half of the year was a little bit more down with a sort of recovery, and the last couple of weeks has been off a little bit again. So at the moment we're sort of a little bit negative to flat, depending on where we start to measure. So we'll probably end up with a year maybe slightly negative, somewhere around the flat mark. So certainly not an average year, but not too far below average. And the other thing we noticed last year in particular was a huge increase in regulation and the response to that. Again, we'd like to thank you all for your assistance in helping us to sort of tick all those new boxes, etc. But 2022 has seen the release of what's known as a quality advice review. That's now been presented to the Treasurer, and we're expecting actually some degree of relief coming into the near future. So again, that's not something that you'll notice too much of, hopefully, but it will certainly make the amount of work we're doing behind the scenes a little bit less, which will be good. So 2022, in a word, I guess, in the end, we sort of regard that as an unwinding year. There's a lot of things, be they supply constraints, be they record low interest rates, the COVID sort of scenario. A lot of things have sort of changed, or finally sort of changed through 2022. So that's the word we've sort of picked for 2022, because it really has been the end of a number of sort of major themes. And we've seen that no more so than in some of the market activity. And we've talked about markets being sort of flat for the year, but we really have seen that change in sort of value disparity. And I've just picked a couple of examples here that would be well known. If I look at Tesla over the last 12 months, down 50%. Meta, which is essentially Facebook, down sort of 65. So these very large, very popular, very well-known companies, quite different, Facebook versus Tesla in many respects, but very, very large companies, been around for quite some time, and we've seen a huge reversal, in their fortunes, particularly in terms of stock prices over the last 12 months, despite the fact that we've seen, as I said, overall a relatively flat sort of market return. And that's really the unwinding of the US. We can see over the last 12 months in the US, an unwinding of both the NASDAQ, being down about sort of nearly 30% over the year, and the S&P 500 being not quite as tech heavy, but down about sort of 16% over the last 12 months. So that outperformance, that market driver of US tech stocks we've been talking about for the last couple of years, we have finally sort of seen that unwind, and that sort of filtered through the markets in a fairly substantial way. And notwithstanding that, because of the positioning portfolios, we've been largely sort of sheltered from any of that sort of major disruption. And just to pick a real sort of highlight in terms of a great example of that is I've looked here at Novavax in the US. So Novavax is a pharmaceutical company, was supposed to be a big winner out of the coronavirus pandemic. And even back in early 2022, after a relatively severe reduction in share price already, there are many analysts, and I've taken just a quick excerpt here from one example, who were still predicting that a company like Novavax would continue to not only prosper but rebound up to some very strong, if not full recovery, to some reasonable sort of highs, implying upsides of sort of 250% from that sort of drop in sort of early 2022. If we fast forward to today, hindsight being a wonderful thing, we now see Novavax share price down to sort of $10, down from sort of 200, or a total unwind of about 95%. So here's a company, that was arguably well positioned to take advantage of the coronavirus pandemic and related sort of opportunities sort of coming out of that. And despite that potential tailwind, we've seen, an almost total collapse of the stock over a very short period of time. It just reminds us that no matter how obvious or how strong a particular theme or opportunity may seem to be, there really is no substitute for making sure that, we diversify and that we have very strong, fundamentals underpinning our portfolios. So 2023, major themes we're expecting for next year. We're expecting interest rates will peak in sort of Q1, probably late Q1 next year. From where we sit today, a couple of rate rises, maybe 0.5% or so from where we sit today. As a result of that, we're going to continue to see property come under pressure. We've seen in certainly Australian capital cities, we're sort of from the peaks off about sort of 10%. We'd expect at least another 10 to 15% from here. And we'll see a lot of the resulting reduction in spending. So probably the real key there, or the next sort of milestone we're looking for, is sort of February, March next year, is there's a huge amount of fixed rate loans that will revert to variables that were sort of undertaken at sort of high 1s to low 2%. So we're going to see about just under 25% of the amount of home loans by volume, by total borrowings, about just under 25% are going to be coming off fixed rates of sort of 2% in the next sort of 3 months. That's going to make a huge adjustment for those people with those loans. Now, some of those people will be reasonably well positioned to manage that, but there's certainly a lot of data suggesting that's going to bring through a whole new round of sort of mortgage stress or cash flow stress. So we don't really see the economic numbers getting much better, obviously, until at least a couple of quarters down from that. We'll no doubt get a lot of talk of recessions and the relative contractions of that. We may even see the interest rate cycle change and come under a bit of pressure as a result. But at this stage, we still think our base theme of interest rates continue to rise a little bit more for the first quarter, and the RBA being very, very slow to react, if at all, in relation to this effective interest rate rise or substantial interest rate rise that borrowers are going to see early in the year. So, as those headlines come out in the next couple of months, just be aware, obviously, that this is something that's entirely predictable. We do see this coming, we do see the potential effect of that. But within investment markets, there are certainly still plenty of opportunities that are well positioned to not be overly subjected to the potential stresses that might play out. But it'll certainly make for some great headlines, no doubt. At the end of the day, earnings drive returns, and we definitely see that theme returning in 2023. We expect markets potentially to be flat from an index perspective as that unwind continues to happen. And those zombie companies, or those companies that haven't been supported by earnings in the last couple of years, start to continue to deflate and replaced by that more sort of cyclical or solid companies sort of appreciating. So we think the returns will be there. We're not expecting it to be a record year by any stretch of imagination, but we do think that unwinding and that rebalancing will continue to occur. And so we think from a portfolio position, we should be reasonably well positioned. So next year is very much going to be about that interest rate cycle, very much around how that impact on property prices does affect particularly consumer spending in the short term, and the flow-on effect to that from a sort of economic growth numbers perspective. But it's important to keep in mind that borrowers do only represent roughly about sort of 40-45% of the market. Even at the highly stressed end of that, we're talking about property prices only returning back to near sort of pre-COVID levels. So we did see that huge spike in property prices after COVID, even with the sort of circa 10% drop we've seen in the last sort of 12 months, and another sort of 10 to 15% here. We're still seeing property being reasonably resilient compared to a couple of years ago. So not a huge portion of the market to come under stress, but those areas that do come under stress could come under pretty substantial stress. So again, that will certainly make for some interesting headlines, but we're not really too concerned about that being a major contagion effect, particularly with unemployment still being at extremely low levels and the sort of jobs market and jobs data supporting plenty of opportunities there as well. So that's our guess. And lastly, we'll chuck in there the reform. We've got a new government, or relatively new government. There's been a lot of legislation passed and a lot more sort of coming, not just in our industry, but in many other areas. So as they go through to their next sort of proper budget, obviously they had a mini budget sort of the end of this year, towards the end of this year, we really do see the new Labor government sort of pushing ahead with a number of the policies that they certainly have in the wings. So we do see that being reform being another word for new legislation, but we'll certainly obviously be keeping an eye on what that means for strategies, particularly in and around super and tax planning for 2023. So that's pretty much it for this year. 2023, in a word, our word here is going to be active. It's going to be a year not to sit back and just let everything happen. There is going to be some need for some changes, not massive structural changes, but certainly we see a little bit more activity in portfolios and particularly some other planning strategies through the year as we return to a more sort of normal market and sort of economic conditions going forward. There'll definitely be some news, there'll definitely be some headlines. Most of those, as I said before, are looking relatively predictable. So, we're cautiously optimistic and we're certainly looking forward to, a brighter 2023 than we had in 2022. So thanks again, and we'll see you all next year.